What you are witnessing right now on the US dollar to Japanese yen charts is not a trend reversal. It is a sophisticated liquidity hunt before the next major leg lower. This is Alpha Market Meridian. I am Eric, and I'm taking you inside the institutional order flow right now. The dollar yen is up 36 basis points, trading at 157.78, but do not let that green number fool you. The 4-hour chart just printed a textbook structural trap, and the multi-timeframe moving averages are aligning for a move that could retest 156.70 within the next 2 trading sessions. If you are long right now hoping for a break of 158, you are standing exactly where the smart money wants you to be. Stay with me. I'm going to give you the 3 precise price levels that confirm the breakdown, and 3 distinct strategies to profit from the yen's hidden strength. Let's cut through the noise. My direct conclusion for May 6th is this. US dollar to Japanese yen remains in a firm bearish correction that threatens to become a structural downtrend. We are in a sell on rips environment. The multi-day price action has confirmed that the break below the psychological 160 handle was not a false alarm. It was a massive distribution phase. As you can see on your screen, the daily chart moving averages are rolling over violently. The 5-day moving average sits at 158.400. The 10-day at 158.850. Price is currently 70 pips below these dynamic resistance levels. As long as we are trading below 158.85, the bears have absolute control. The bulls need a daily close above 159.46, the high from April 27th, to even begin neutralizing this momentum. Until then, my bias is short. Please remember to subscribe my channel. Now, let's move to the execution timeframe where the trap is most visible, the 4-hour chart. This is where the institutional footprints are clearest. Look at the moving averages I'm highlighting right now. The 20-period moving average is at 157.116. The 40-period is critically at 158.261. We are observing a bearish alignment where the shorter-term dynamic averages are rolling below the longer-term ones. This is a death cross setup in progress. Price is currently squeezing between the MA20 and the MA40. This squeeze is unsustainable. The MACD on this timeframe is barely holding above the zero line, with a reading of 0.359, and it's flattening. It's not curling up aggressively, it's stagnating. What does that tell us? There is no momentum behind this bounce. It's purely mechanical short covering and position squaring. The real volatility is loading right at the 158.20 resistance cluster. A rejection there is the highest probability trade of the day. You cannot trade the dollar yen without watching the Nikkei 225. Usually, the yen is the safe haven. If the Nikkei tanks, the yen strengthens, and US dollar to Japanese yen drops. This inverse correlation is the heartbeat of the carry trade. Right now, we are seeing a divergence that screams liquidity trap. The Nikkei has been attempting a stabilization bounce as well, but it's not impulsive. If we look at the Nikkei 4-hour chart, it's rejecting its own long-term moving average. If the Nikkei were truly bullish, US dollar to Japanese yen would be rocketing toward 159 right now. It's not. The weakness of the Nikkei bounce confirms the weakness of the dollar yen bounce. This cross-asset verification tells me that risk appetite is dangerously low in Japan. If the Nikkei breaks down from here, and I suspect it will, US dollar to Japanese yen will not just drift lower, it will cascade lower. The alignment of a weak Nikkei and a rising yen is precisely the environment where the Bank of Japan likes to stay silent. For getting instant forex message, please subscribe my channel. Let's bridge the charts to the macroeconomics, because the fundamental gravity here is immense. Why is this happening today? First, look at the US rate narrative. The differential between the US 10-year Treasury yield and the Japanese government bond yield is the engine of this currency pair. Overnight, we've seen a continued compression of US long-end yields. The market is pricing in a lower terminal rate for the Fed, which shrinks the carry trade premium. Why hold dollars if the interest rate advantage is shrinking? Second, the silent BOJ. The Bank of Japan isn't necessarily raising rates aggressively this week. They are doing something more dangerous to dollar bulls. stealth quantitative tightening through reduced bond purchases. This is passively strengthening the yen without triggering an explicit intervention headline. And third, the geopolitical risk premium. With the calendar shifting into mid-2026 uncertainty, the yen is attracting safe haven flows that are not showing up in gold necessarily, but are specifically sheltering in the Tokyo Forex market. The 159 area we saw on April 27th was the liquidation of the last mega longs. The pipeline has been cleared. Let's talk about the trap that just happened. Looking at the April 27th daily candle, you see a massive spike to 159.46, but the candle closed near 159.0. This is a classic topping tail or an exhaustion gap fill. We ran the stops above the April highs and immediately dumped. The 5-day moving average was at 159.436 then. Now, it has crashed to 158.4. This is a dynamic acceleration of the downtrend's velocity. The current bounce to 157.78 is occurring on abysmal momentum. The RSI on the 4-hour time frame is sitting at 75.409, yet price hasn't even broken the prior local high. That's bearish divergence in real time. The relative strength index is overbought while price structure is bearish. That's a fuse box. Ready to blow. Here are your battlefield lines for the next 24 hours. Pay close attention. Resistance, the line in the sand, is 158.85. which aligns with the daily MA10. Above that, the final fortress is 159.46. On the downside, immediate and fragile support sits at 157.00. A breach there opens the trapdoor. The first structural demand zone is 156.74, which is the recent swing low visible on your 4-hour chart. Below that, we are targeting the lower boundary of the descending channel at 155.710. This is where we convert the analysis into equity. I'm about to give you 3 distinct strategies, from conservative to radical, to trade this bearish dollar-yen thesis. Pick the one that fits your risk profile. Strategy 1, the conservative fade. This is the high probability play. We wait for the 4-hour candle to climb into the resistance zone and show exhaustion. You enter a short position only if price rallies to 158.20 and stalls, confirming a rejection with a bearish engulfing candlestick pattern or a long upper wick. Your stop loss is placed above the structural high at 158.90. This gives you a tight, logical invalidation point. If price closes above that, the daily MA10 is breached, and we stand aside immediately. Your first target is the opening price of this week, around 157.18. The second target is the swing low at 156.74. This provides a risk-to-reward ratio comfortably above 1 to 2. This strategy relies on patience. Don't jump the gun. Wait for the manipulation into the supply zone. Strategy 2, the momentum breakdown. This is the standard aggressive play for those who can monitor the screen. You bypass the fade at resistance and instead wait for the trend to confirm itself. Your entry trigger is a 1-hour candlestick close below the intraday support of 157.00. This confirms that the consolidation phase is over and the markup to 158 was indeed a trap. Once you see that close, you enter short immediately at market. Set your stop loss slightly above the midpoint of the consolidation range, around 157.55. Your target is aggressive. The April lows at 155.710. Once price clears 156.70, move your stop loss to break even. This strategy captures the waterfall acceleration phase. The logic is sound. Breaks of integrity at 157 signal the liquidation of the remaining weak longs. Strategy 3, the radical resistance scalp. This is for the professional risk takers only. High risk, tight stop, massive potential reward. This is based on the hypothesis that the price cannot physically cross the 40-period moving average on the 4-hour chart. You enter a limit sell order at the exact moving average level, 158.26. You are front-running the conservative entry. Your stop loss must be razor-thin, placed at 158.55. That's less than 30 pips of risk. This is a binary bet on the moving average acting as a perfect dynamic ceiling. Your immediate target is 157.00. Your extended target is 156.10. If this works, you're getting a 5-to-1 reward ratio because you bought the exact top tick. But I repeat, this is exclusively for those who understand that rapid rejection carries high slippage risk. If the zone breaks, you are out immediately, no questions asked. Before we wrap, let's look that risk management square in the eyes. We are trading a currency pair defined historically by violent interventions and policy shocks. Do not allocate more than 1 to 2% of your trading capital to any single one of these three strategies. The Bank of Japan has proven that they will erase billion-dollar positions overnight if they decide to step in verbally or physically. Furthermore, we have US Treasury auctions this week which can spike yields temporarily and cause a short squeeze. If you're in a position right now, I highly recommend tightening your stop losses, particularly ahead of the New York session overlap. Strategy is useless without survival. Here is your summary for May 6th. The US dollar to Japanese yen intraday bid is a trap. The multi-time frame analysis, from the daily morning star failure to the 4H death cross, confirms a bearish structure below 159. The correlation with a struggling Nikkei 225 validates the yen strength. Fundamentally, the narrowing US-Japan rate differential and stealth BOJ tightening are pulling the floor out from under the pair, and here is what you absolutely cannot miss tomorrow. We shift focus to the US 10-year Treasury auction results and the JGB buying schedule update from the Bank of Japan. If the BOJ announces a reduction in purchases on the long end, which is the primary risk I see, the US dollar to Japanese yen fallout will be immediate. Also, keep your eye on the Nikkei futures at the Tokyo Open. If they gap lower, the sell-off I am anticipating accelerates. You have the charted map. Now it's your turn. The engine of this market is the expectation of central bank divergence, but that divergence is dying. So let me ask you, where exactly does the bull case die for you? Give me your precise multi-year line in the sand for US dollar to Japanese yen. Drop your number in the comments right now. Is it 158.80, 159, or do you think the highs are in? I read every single comment in the first 30 minutes. So get in there and stake your claim that if you treat the market like a business, not a casino, you need to be here every single morning. Accelerate your execution by hitting that like button with conviction if you're short the dollar. Make sure you subscribe and ring the notification bell. I cover 8 distinct assets every day, from Bitcoin and the S&P cross analysis to gold and oil, so you're never missing an institutional level pivot. This is Alpha Market Meridian, signing off. I'll see you in the Asian session. Let's get to work.